Today, we marvel at the big tech companies, not because of their ability to reinvent and remain relevant, but because of their ability to avoid paying taxes and even receive refunds. The Silicon Six are some of the biggest offenders in what could be described as tax antics, a gang also known as FANG, made up of Facebook, Amazon, Apple, Netflix, and Google, aka Alphabet, plus Microsoft. In 2018, Amazon earned $10 billion in income. You're probably thinking they had a big tax bill, right? Nope. Instead, they earned $129 million in rebates. Now that's impressive. Making enough money to buy a country and still getting a pizza party thrown for you on a taxpayer's dime. So how do these mother hustlers manage to dodge the tax man and bring home billions while you and I barely bring home the bacon after paying our share? Well, we're about to unpack some of this in How Tech Companies Made Billions and Paid Zero Taxes. It's not illegal, but it's also not right. Imagine being given an exam and then being asked to write down the questions you want to be asked. Well, that's how big tech and a lot of companies in general get full marks for tax evasion. They have money and clout to campaign, or lobby as they call it in the US, for exactly the tax breaks they want. It's legit, and they aren't necessarily backroom deals. The Institute on Taxation and Economic Policy did their homework on this big tech taxation avoidance. The authors Matthew Gardner and Steve Wamhoff explain, by all appearances, the companies described in this report appear to be using entirely legal means to reduce their tax bills. So, legal, yes, but does it make it right? Nope. They still use public resources like roads and infrastructure, public health care, homeland security, and they have access to all the benefits of the rules and protection of a country that any company enjoys. Yet they aren't contributing to the upkeep of these services, but small businesses and taxpayers are. So, what are the figures that we're talking about? The savvy crew at the Institute on Taxation and Economic Policy analyzed the SEC filings of Fortune 500 companies and found 60 major corporations that didn't report any federal income tax expenses in 2008. 11 of those are tech or transportation companies. In the 2018 financial year, Amazon reported a U.S. income of $10.8 billion. Instead of paying any federal tax on that, they received a 1% tax return, which equates to $129 million in refunds. In a statement to CNBC, an Amazon spokesperson noted that Amazon paid billions in taxes other than the federal income taxes, including state and local taxes. They also reported that Amazon had created more than 250,000 jobs at that time. But many of these are low-paid workers who rely on subsidized government services like schooling, transport, and medical services. The spokesperson went on to explain that Amazon pays all the taxes we're required to pay in the U.S. and every country where we operate, including paying $2.6 billion in corporate tax and reporting $3.4 billion in tax expenses over the last 3 years. Corporate tax is based on profits, not revenues, and our profits remain modest given retail is a highly competitive, low-margin business and our continued heavy investment. We suppose that's why Jeff Bezos has such a modest income. And if you think that's bad, IBM posted $500 million in income and received 68% back, which equates to $342 million in rebates. You might say that the US government is IBM's biggest customer. But will this bubble burst? We think so. Stick around to find out how. The Tax Cuts and Jobs Act of 2017 left a poor inheritance. This isn't a new habit of the rich and infamous tech companies, but in 2017, things got a whole lot easier. The Trump administration's Tax Cuts and Jobs Act of 2017 didn't address any of the concerns related to how the major U.S. corporations dodge taxes. Instead, the new act actually favored it. The act brought corporate tax to 21%, down from 35%. It also allowed companies to immediately write off the cost of capital investments in equipment via accelerated depreciation. Other perks included tax breaks on executive stock options or on research and experimentation, previously research and development or R&D, which brings us to our next glaring loophole. R&D has become a scapegoat. Research and development, R&D, or research and experimentation has always been part of the write-off costs of business. While you might say that this drives investment and innovation, the truth is that tech businesses don't need more tax incentives to innovate or seek investment. That is core to what makes their product succeed, incentive or no incentive. It's like the way Starbucks offers you loyalty stars, but you probably would have gone there anyway, right? R&D incentives predate the digital era where innovation is the product. Or perhaps Anup Srivastava, an associate professor at the Haskayne School of Business in Canada, puts it best in this explanation. The idea that R&D is discretionary, that you need to incentivize companies to invest in R&D, is long gone. For these kinds of companies, R&D is required for their survival. COVID and tax breaks like the CARES Act. When disaster strikes, it's important for government to respond with tax breaks that protect businesses. However, special tax allowances don't always benefit the most vulnerable. For example, the CARES Act that the U.S. rolled out to minimize the economic impact of the COVID-19 pandemic allowed big business to cash in. The Institute on Taxation and Economic Policy reported that the CARES Act provided a new avenue of tax avoidance by allowing companies to carry back losses to offset previous profits. In other words, instead of paying tax the 21% required on the previous year's profits, many received tax rebates on their 2020 profits. In dollar bills, that means that instead of the 55 biggest companies that avoided the U.S. federal tax paying in $8.5 billion in tax, they received $3.5 billion in tax rebates from the U.S. government. That's right. In a time when the government needs more tax income to be able to provide immediate aid to the public, they instead paid out $3.5 billion to big business. And Aluxers, if big trades fascinate you, then why not consider mastering crypto trading? Alux has created a course that teaches you all you need to know about blockchain and cryptocurrency trading. Go to Alux.com/Bitcoin and enroll now. Stateless income and tax havens. Another bit of fancy footwork big tech can use with ease is creating stateless income. This is, in effect, moving their profits to tax havens and reporting their losses in countries where the tax is high, and so are tax returns for expenses like R&D. So, what is a tax haven? Countries like Bermuda, Luxembourg, or Ireland attract big business to their shores by offering little or no company taxation. This is an awesome offer, so big tech and other multinational companies set up their head offices in these regions. From here, they do all of their invoicing and let the bank roll in. The UK is a huge income territory for Facebook. They posted $1.3 billion in annual sales, but only paid $40 million in taxes to the UK government. This is because they based their headquarters in Dublin, Ireland, to benefit from the lower tax rate. At the same time, across the world in countries that offer great tax back for skills development, asset investment, or our dear friend R&D, they set up small offices with the sole purpose of spending money. This can generate income for the company in the way of refunds. It's the same as if these companies were using a rich uncle's money to train up a specialized workforce with the skills they need to succeed, or giving your staff a bonus, or getting an interest-free loan to build a huge fancy campus, and also getting tax credits for the investment. Except the rich uncle is the government, and his money is our money, the taxpayer. But big tech is being called out for these tactics, and this is about to change. Keep watching to see how. But first, do you think it's fair that big tech companies get away without paying tax, while small business or individuals foot the bill? Share with us in the comments and join the conversation. Now, you stuck with us until the end. Of course, we have saved a bonus for you. Change is coming to big tech taxes. In April 2021, the Organization for Economic Cooperation and Development, or OECD, met to discuss global tax arrangements. The Biden administration from the U.S. proposed a document to 137 countries that lays out universal taxing for multinational corporations. This means that the likes of big tech won't be able to hide profits in tax havens and show losses in other territories, but rather pay a global minimum. The universal figure proposed was a 21% corporate tax across the board no matter where the head office is based. This equates to an additional $81 billion in income globally to go to the government where the sales are taking place. That is 3.2% of all global corporate income tax revenues, which to date isn't being collected. Thanks for watching, Aluxers. Hit that like button if you appreciated the video, and don't forget to subscribe for more.